Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome back to the Deep Dive. We are jumping straight into the sources today.
We really have to.
Yeah, because the market is giving us this massive, almost, painful paradox to wrestle with. So our mission today is to take these two stacks of sources, one showing just extreme macro-political chaos, the other showing this quiet, determined, foundational fintech progress, and try to figure out which one is actually steering the future of digital assets.
And the current numbers, they really highlight that pain perfectly. Bitcoin is currently priced around $103,693. That's down nearly 5% over the last 7 days.
Ouch.
Yeah, even though the global crypto market cap is still holding pretty strong, relatively speaking, at $3.5 trillion.
And here's the core paradox, the big question. Satoshi Nakamoto's founding vision was all about the separation of money and state. Crypto was supposed to be the immune system against government dysfunction, right?
That was the idea.
Yet, our sources today make a stunningly clear case, maybe uncomfortably clear, that the current crypto market is being directly and negatively impacted by the actions of the U.S. government. Specifically, this prolonged government shutdown.
We probably need to understand the scale of the political friction first, just to set the scene. The U.S. government shutdown began back on October 1st, 2025.
Right.
And as of the date on our source material, it had hit its 36th day. That officially makes it the longest shutdown in U.S. history.
The longest ever. Wow.
And this political fight, which the source we're looking at attributes to the Democrats blocking appropriations bills, well, it's now sending these tremors across global markets, which, as you said, totally contradicts that initial decentralized vision.
Okay, let's unpack just how deep this connection runs. Our sources actually pinpoint 6 specific financial mechanisms. 6 ways this political gridlock is hitting Bitcoin and, the wider crypto world. The first one, and maybe the most crucial, is the liquidity crunch.
It's sort of a mechanical issue, really. The U.S. Treasury General Account, that's basically the federal government's massive checking account, it's nearing $1 trillion.
$1 trillion just sitting there.
Essentially, yes.
Yeah.
This cash is being pulled out of circulation. It's being held to cover essential payments during the shutdown, and that starves the wider markets of liquidity. Dollars just aren't available.
And we saw the direct consequence of that starvation, didn't we?
Exactly. The Federal Reserve Board actually had to inject $30 billion through repo operations.
Repo. Can you quickly explain that?
Sure. It means the Fed had to basically loan cash to banks overnight just to maintain stability because things were getting tight.
Right.
And it's the first time they've had to do that since 2019.
Okay, so less liquidity.
Less liquidity means investors flee risky assets first. That's just how it works. And Bitcoin, which had been doing pretty well before this, it's fallen more than 21% since the shutdown began on October 1st.
21%. That plunge leads us straight to the second point. Market pressure and volatility. The fear isn't just in Washington anymore.
No, it's global. The shutdown is feared to cut maybe 1.2% off U.S. Q4 GDP growth, and that fear is really settling into global markets now.
So Bitcoin's stuck, hovering between, what, 101K and 103K?
Right, which is dramatically down from the $150 we saw right before this whole political fight kicked off.
But wait, here's something fascinating, maybe contradictory. In the source material, some analysts are calling this massive 21% drop a healthy flush.
Yeah, it sounds odd, I know. The thinking is that it's clearing out weak traders, sort of shaking out the leverage before a potential robust rebound.
Okay, Bitcoin is down over a fifth since the shutdown started, and analysts are calling it healthy. That sounds a bit like classic cope, doesn't it? I mean, what metrics actually support that view beyond just saying volatility happens?
Well, the support cited is purely technical analysis. They're pointing to, strong fundamentals in the mining community, certain whale accumulation patterns, things like that, suggesting that the retail fear we're seeing is disproportionate to the institutional belief in the long-term value. Essentially, they see the price drop as an artificial political event, not some structural flaw in Bitcoin itself.
Okay, I remain skeptical, but let's assume that's their argument.
Yeah.
So if that's the case, how did this liquidity squeeze and price drop translate into actual institutional behavior? That brings us straight to the third impact.
Yeah.
Massive ETF outflows.
Yeah, this part isn't ambiguous. Institutions are clearly reducing their crypto exposure because of all this macroeconomic uncertainty.
The numbers.
Total outflows recently hit $266.6 million. And the Bitcoin ETFs, they accounted for $238.5 million of that. Ethereum ETFs saw about $28.1 million leave.
So the big funds are definitely spooked.
It signals a really pronounced risk-off mood, even among the big players. They're pulling money out until this political fog clears. Simple as that.
Okay, fourth impact. The regulatory freeze. This one feels almost predictable, with Congress basically paralyzed.
Nothing's moving. Critical crypto-related regulations, things like stablecoin rules, maybe approvals for new types of ETFs, they're all just on hold.
And the SEC, the CFTC, they're partially inactive too.
Exactly. Which slows down progress on new crypto products getting to market.
But, this raises a really profound point, doesn't it? The government shutdown unintentionally becomes like the best marketing campaign for decentralization.
It's a fascinating irony. The longer the government stalls progress on regulated pathways,
the stronger the argument gets for fully decentralized finance. DeFi doesn't need congressional approval or SEC filings. It forces people to really consider crypto's potential for independence.
Absolutely. Okay, moving to the fifth point. The confusing signals around Bitcoin as a safe haven asset.
Right. Initially, it seemed to behave exactly as you'd expect, like digital gold. It rose alongside physical gold as a hedge against all this uncertainty.
It did, briefly. But as the liquidity crisis got worse, really started to bite.
That correlation broke.
Completely. Bitcoin started to plummet, confusing investors. Is it a risk asset or is it a hedge?
It highlights maybe a maturity problem.
I think so. Bitcoin is still incredibly sensitive to dollar liquidity. When the dollar system gets jammed up, yeah, Bitcoin might initially react like a hedge, but when that jam pulls all the cash out of the entire financial system,
Bitcoin still gets caught in the broader sell-off, like other risk assets.
Exactly. It gets liquidated too.
Okay, and finally, the sixth area. This one is maybe the most shocking number. The debt boom and the macro ripple effects.
It's staggering. The U.S. has borrowed over $600 billion just since the start of October.
$600 billion. In like 5 weeks?
That works out to about $17 billion per day.
Wow.
And that kind of rocketing debt profile, it shakes confidence in U.S. fiscal stability globally. You see it immediately drag down NASDAQ futures, tech stocks.
And because crypto is still pretty correlated with tech stocks.
Cryptocurrencies get pulled down right along with them. It's a chain reaction.
What's fascinating, though, is the potential for an immediate reversal. The sources suggest that once the shutdown does end, the Treasury could release this flood of liquidity back into the markets.
Right. The money comes back out of the TGA.
And analysts are already predicting a possible Bitcoin rally to $118,000 if a deal gets done before Thanksgiving.
That's the speculation. But it's a huge if, isn't it? And you have to ask how much of that prediction is based on, real fundamental change in the tech versus just banking on a political quick fix.
Yeah, it really speaks to how dependent the market still feels on Washington, despite that whole decentralized promise.
It does. And the political solution being floated to sort of hasten that fix is the so-called nuclear option.
Bypassing the filibuster?
Exactly. The maneuver to pass spending bills with just a simple 51-vote majority in the Senate. The source indicates there might be enough senators getting ready to actually pull that trigger.
So the market is sweating bullets because of Washington gridlock. But here's the beautiful irony. While Congress is stalled, the builders, they aren't. Let's look at what's actually being constructed underneath all this surface volatility. Because the foundational work, integrating digital assets into traditional finance, that seems to be accelerating globally.
Yeah, and before we dive into the specific projects, maybe let's frame the sheer size of the opportunity here. The entire crypto market fundamentally is trying to chip away at this enormous valuation gap.
The gap between digital assets and traditional safe havens.
Precisely. Bitcoin's current market cap is around $2.06 trillion, which sounds huge until you compare it to gold.
Which is?
Gold stands at a staggering $25.77 trillion.
Wow, okay. That's a big gap.
That gap is the target, and tokenization is arguably the main lever to bridge it.
Speaking of levers, let's start with regulated stablecoins then. Ripple has made a really significant institutional move here, teaming up with MasterCard, WebBank, and Gemini.
Yeah, this is a big deal. They are actively testing Ripple's regulated stablecoin, which is called RLUSD on the XRP ledger.
And the goal?
The goal is to dramatically improve how fiat settlement works for credit card transactions. Make it faster, cheaper.
And this isn't just theory, right? RLUSD is live.
Oh, yeah. It launched in 2024. It's fully backed by cash reserves under strict New York Department of Financial Services regulation that's key. And it's already surpassed $1 billion in circulation.
So this aims to merge, traditional banking reliability, backed by serious NY regulation with the speed and efficiency of digital assets.
Exactly. It's about making stablecoin-powered payments a trusted core part of everyday finance, not some fringe thing.
It's a powerful, regulated bridge to TradFi.
Mm-hmm. And that bridge-building theme continues with the tokenization of a traditional market index. Look at what Denari is doing with S&P, Dow Jones Indices, and Chainlink.
Okay, tell us about that.
They're launching the S&P Digital Market 50 Index.
What's in the index?
It's a major benchmark. It combines 35 blockchain-related public companies, think miners, exchanges, that sort of thing, plus 15 major digital assets.
And crucially, this index will be tokenized on the Denari Share platform.
Correct. And each token representing a share of that index is backed one-to-one by the actual underlying assets, held securely with a regulated custodian.
That custody part is critical for institutional trust.
Absolutely essential. And the whole system is powered by Chainlink's Oracle network.
Providing the data feeds.
Right. Providing verifiable, real-time, on-chain data. That's what assures investors that the tokens accurately reflect the value of those underlying assets. It's basically moving the entire infrastructure of traditional indexes onto the blockchain with transparency.
Okay, so while DC is tied in knots, real building is happening. Now, let's shift our focus globally. Let's look at the geopolitical competition for digital asset leadership, particularly in Asia, because things seem to be moving really fast there.
Hong Kong is making a very aggressive, very public push. It's all part of their new Fintech 2030 strategy, and it's sending a massive signal to the global financial industry.
And the big signal came in the form of Franklin Templeton.
Yes, they successfully launched Hong Kong's first tokenized USD money market fund.
A tokenized money market fund. So what does that mean practically?
It means the fund invests in safe, short-term U.S. treasuries, just like a traditional money market fund. But instead of traditional shares, Institutional investors hold digital tokens representing their ownership in the fund.
Institutional only, though, not for everyday folks.
Not yet, no. It's available only to institutional and professional investors. The minimum is pretty high, about $1 million USD in assets.
Okay. And the source suggests this puts Hong Kong ahead of Singapore.
That's the argument presented. The source emphasizes that this rapid deployment positions Hong Kong ahead because Singapore has taken a much slower, more cautious regulatory path. Hong Kong seems to be using regulation not as a brake, but as a framework for really aggressive deployment. They're even testing things like 24/7 fund settlement with giants like HSBC.
Interesting. Using regulation to accelerate, not just de-risk.
Right, competing hard to be seen as Asia's leading hub for regulated blockchain finance.
Okay, we also need to look at the massive digital infrastructure growth happening in the Middle East, particularly the UAE and Saudi Arabia. It shows how national governments are really pivoting to capitalize on these new sectors.
Yeah, start with the UAE's Bitcoin mining expansion. NIP Group, partnering with the Abu Dhabi Investment Office, ADIO, is significantly expanding its Bitcoin mining capacity right there in Abu Dhabi. They're targeting 11.38 exahash per second. That's a huge amount of computing power.
And that reflects this convergence we're seeing, right?
Yeah.
Gaming, AI, crypto, high-performance computing, all coming together.
Exactly. It's like they're building this economic cluster around all these high-growth digital sectors in the region. They're literally building the physical backbone needed for the digital economy.
Meanwhile, next door in Saudi Arabia, the government is leaning heavily into AI, but for public services.
Yes, they launched a new AI-powered service called Shamil. It's integrated into their massive national app, Tawakkalna.
Tawakan is huge there, isn't it?
It's enormous. Shamil uses AI for smarter user interactions. Citizens can chat with it in colloquial Arabic to ask about official documents, get travel info instantly, things like that.
And a scale of Tawakkalna overall.
It's now delivering over 1,100 digital government services. And it handles more than 65 million transactions per day.
65 million a day. Their goal is to unify everything under that one app by 2026.
That's the plan. So this isn't just, a fancy app. It's a government fundamentally digitizing its entire citizen interface. It shows remarkable digital maturity and commitment.
So if we kind of zoom out on all these developments, Ripple stablecoin, Hong Kong's funds, Saudi Arabia's AI government, it seems clear that the actual foundations for a regulated, integrated digital economy are being laid globally, even while the U.S. political system is generating all this extreme volatility.
That's the key takeaway, I think. The short-term noise versus the long-term build.
So, okay, wrapping this up, what does this all mean for you listening? We've seen pretty clearly that political uncertainty creates these dramatic price drops, all this volatility in the short term. It proves the crypto market is still highly correlated with macro political confidence, like it or not.
Definitely still linked.
But the beautiful irony, maybe the optimistic part, is that the fundamental work integrating digital assets into traditional finance via tokenization, via regulated stablecoins at work, is accelerating globally, especially in these competitive hubs like Hong Kong, like the UAE, that are eager to seize leadership. The future is being built even as the current market sweats.
And just to reiterate the massive opportunity, that gap we talked about, Bitcoin's market cap around $2.06 trillion today.
Yeah.
It still trails gold at $25.77 trillion. And even some tech giants, NVIDIA at 5T, Apple at 4T, Microsoft at $3.08. Bitcoin is currently fifth globally by market cap.
And the sources anticipate the global crypto market could cross the $4 trillion mark if investor confidence comes back after the shutdown.
That's the projection, yes. Contingent on confidence returning.
But the real prize, the true target, is at $25.77 trillion valuation held by gold. And arguably, the only way the digital asset world bridges that massive gap is by tokenizing the physical world, by bringing real-world assets reliably onto the blockchain.
That seems to be the path forward.
So, considering the successful tokenization of things like market indexes and money market funds that we discussed today, the question we'll leave you with is this. How quickly will the massive established financial world decide that the cost of not tokenizing their assets actually outweighs the perceived risk? And when they do make that shift, how fast will that process start to close the huge valuation gap between today's, say, $2 trillion digital economy and that $25 trillion physical safe haven market?
A lot to think about there.
We'll leave that thought with you.